what this is saying here is very, very basic, and this is very important, so pay attention here. So for every action, if I punch with this hand, Okay, so in this video, we're discussing the two different methods that I've seen throughout my career in accounting over the last 16 years of recording your journal entries, your debits and credits, right? There are two methods that we'll discuss today. One relies on remembering an acronym, dealer, and the other method relies on understanding the foundation, the accounting equation, the story of everything in accounting, right? And from what I've seen, what people do is when you start out as an accountant, you normally begin with this, right? You're mechanically remembering, and we'll go through it in a minute here with examples. You're remembering mechanically how to record your debits and credits, right? Based on remembering this acronym here, dealer. And then as you progress in your career, you understand the foundation of accounting, you use this. This becomes a second nature, and this is the one that I recommend. Once you get the accounting equation and you use it to record your debits and credits, you'll unlock a superpower as an accountant, right? That's gonna supercharge your career because you're gonna be faster in your feet whenever you're dealing with a complex accrual or a reversal in your general ledger, and you know your debits and credits based on accounting equation. You're just gonna move faster than your peers, and that's gonna unlock a lot of promotions, a lot of progress in your career. You're gonna be able to move faster with method number two. All right, so having said that, it's important to realize and remember why we have this double entry accounting of debits and credits to begin with. Why are we even doing this, right? And the easiest way to think of this is that it's similar to the laws of physics that says for every action, there's a reaction that's going to be equal in force and opposite in direction. So for every action, if I punch with this hand here, right, I have a reaction from my other hand that's going to be equal in force and opposite in direction. So the same thing in business when you have a transaction, for example, like spending cash. So let's say, for example, you buy an asset like a laptop, right? So your cash went down, but on the other hand, your assets or computer went up. So you have cash going down, but you have your computer going up and your assets, right? So you have an action and reaction. That's the easiest way to think about why we have debits and credits in the first place. All right, now enough of that, and let's jump into these two methods here and understand how they work, and then I'll give you some examples to illustrate these two methods here. So for method number one, dealer, this is an acronym that you remember, right? And dealer, the first three letters are going to be the debit nature accounts, and the LER is going to be the second three letters that are going to be the other side. So with dealer, the D is for dividend, the E is for expense, and the A is for asset. And what we're saying here is that these three types of accounts have a debit nature, right? And on the other side of the word dealer, we have L. L stands for liability. E stands for equity. And the R stands for revenue. Okay, and what we're saying here is that these three accounts have a credit nature, meaning that when you have one of these accounts that you want to increase its balance, you're going to be debiting that account. And similarly, when you have one of these three accounts that you want to increase its balance, you're going to credit that account, right? So that's a very simple way to remember your debits and credits. And we'll go through some examples here in a minute, but first, I want to show you the accounting equation method, because in my opinion, this is going to unlock a lot of superpower in your career. And you let me know in the comment box below, what do you think in terms of which one you're using today? Are you using this or something similar, or are you using the accounting equation that we'll talk about here in a second? So with the accounting equation, now the accounting equation says that assets equals liabilities plus owner's equity, right? And this is the story of everything in accounting. If you understand this formula here, you'll understand everything in accounting, right? Assets equals liabilities plus owner's equity. Let's first spend a minute in understanding why this formula here makes a lot of sense. Also, as a quick announcement, the Controller Academy is now open for enrollment. You can find out more information by clicking the link in the description box, but in a nutshell, it's a 5-hour online course that can take you from an entry-level accountant to a corporate controller. Put another way, this course is a download of everything that I know as a corporate controller and into your brain. So the reason why this formula here makes a lot of sense is because it's saying something very basic. What this is saying here is very, very basic, and this is very important, so pay attention here. So what we're saying here is that what you own in a business, the stuff that you own stuff, right? You own assets, right? Always equals what you owe, right? So imagine a scale with two sides, some stuff here and some stuff here. And this side is what you own in the business, or the assets, the stuff, equals what you owe, right? Then you might look at this and say, well, Bill, what are you talking about? Liabilities is what you owe. Owner's equity, you don't owe that, right? Wrong. You owe equity. The business owes that money to someone. Who does it owe it to, right? To the owners. The owners one day, if they want to liquidate the business, this is what they're owed in the business, or this is what they can take out, right? So what the business owns, its assets, equals what the business owes, which is its liabilities to third parties, and owner's equity to the owners of the business itself. All right, now with your understanding that this formula here makes a lot of sense, it's only saying that what you own in the business equals what you owe. That's all it's saying, right? It makes a lot of sense. Now, this formula here is going to unlock all of that with just understanding the formula. Let me explain this bit here. This is important, right? So what we're saying here is that the two sides of this, assets equals liability plus owner's equity, the asset side is going to always be a debit, and the liability and equity side is always going to be a credit, right? So that will help you do your debits and credits for assets, liabilities, and equity. So then you might come along and say, well, Bill, what are you talking about? What about all of the other accounts? What about dividend, expenses? What do we got here? Revenue. What do we do with these things, right? They don't exist here. Okay, so I'll tell you how they exist here. So when we look at something like dividends, right? Whenever you measure anything, you measure it on equity, right? What does dividend do to equity, right? Dividend is going to reduce equity, right? So that means that dividend has the opposite nature of equity. If equity is credit, dividend is going to be a debit. So dividend is going to fall here. Now, same thing, expenses. What does expenses do to equity, right? And this is very important. What does expenses do to equity? Expenses will reduce equity, right? When you spend money, you reduce in equity. That means it has the opposite nature of equity. If equity is credit, expenses is a debit. So that's why I didn't like you when I said that the accounting equation here explains all of the debits and credits in it. You don't have to remember this. This is good to remember at the beginning of your career. I'm fine with it. Even for now, sometimes I have this handy as a cheat sheet, which is fine. But understanding this will help you move very fast when you are trying to resolve accounting questions, debits and credit questions. Okay, so we said that on the debit side, we got then, what do we got? We got the assets on the debit side. We got dividends. We got expenses. All of these are debits, right? Then you might ask me then, well, Bill, what do we do with revenue? All right, same thing. Same thing with it for expenses. When we said expenses, we asked, what does it do to equity? We said expenses reduces equity, therefore it's going to have the opposite nature. Fine. What about revenue, right? Same question. What does revenue do to equity? Very simple. Revenue will increase equity. When you get money coming in, that will increase your equity, right? Then it's going to have a similar nature to equity, which means it's going to be a credit. So we're going to have revenue on this side, right? That's going to be a credit. Therefore, the accounting equation can explain the debits and credits. You can remember debits and credits by remembering the accounting equation: assets equals liabilities plus owner's equity. This is fine if you want to use this. Dealer, it's a good cheat sheet, good way to remember quickly. Dividend, expenses, asset, liability, equity, revenue. But the better way, if you really want to unlock a superpower as an accountant, is understanding the accounting equation and how it determines the debits and credits. Debits on one side, which is the assets, and then credits on the other side, liabilities and equity. When you try to determine dividends, expenses, and revenue, you think to yourself, what is the effect on equity? If it has an opposite or a bad effect on equity, it means it moves in the opposite direction of equity, which equity is always a credit. Okay, so I think this makes a lot of sense. If you remember this is going to unlock a lot of understanding for you. So go ahead and watch this lecture again to understand the accounting equation, and I'll see you in the next lecture. All right, how about we go through a couple of quick examples so that you can concrete your understanding of what we talked about here. So let's talk about a couple of transactions. The first one is that let's say you receive a seed investment of $100,000, right? A seed investment of $100,000. So receive a seed of $100,000, right? A seed investment is an initial investment in the business, right? So what's going on here? Remember that we said with debits and credits, it's going to be similar to the laws of physics of action and reaction. You have action and reaction, right? So double-sided journal entry, you have on one side, you have cash being received, right? So you have cash coming in, right? And then the other side of that journal entry is going to be something, but is it revenue? You haven't really sold anything, right? So what is it then? It's equity, right? So this is going to be part of equity. Okay, so you got equity here. All right, let's do it in the form of a T account. So when we are recording journal entries, we're using T accounts. All right, we got $100,000 coming in. So cash coming in, cash went up, right? Cash is what? Is an asset. So if you use this method here, cash is an asset. To bring it up, it's a debit, right? So it's going to be debit to asset for $100,000, right? And equity, it's right here. It's credit in nature. To increase it, it's going to be also $100,000 on the credit side, okay? And if you do it using this method, it's going to be the same thing. So asset coming in, cash coming in, 100K, right? It's an asset, right? It's a debit. Then it's 100K on the debit side. Equity, you're increasing equity by 100K. Equity is in here in the accounting equation. It's a credit. You would have credit on this side. Okay, so that's one example. Let's go through a second example here. All right, purchase a computer for $3,000. Okay, so buy PC for $3,000. All right, so you got two sides to this. Remember, action, reaction. You spend some cash to get this, right? So you have cash, right? And you have a computer. That's the opposite, the reaction or the opposite, right? So you got cash, you got PC or computers, right? Let's do a T account. So here's a T account for cash, T account for computer, right? You got $3,000 for cash. Now cash is going out the door, right? So you're reducing cash. To reduce cash, it has a debit nature. To reduce it, you're gonna have to credit it. So credit the cash for $3,000, right? And you got computers, that's gonna be going up to increase an asset, right? Right here, it's a debit, so that's $3,000. Your debits and credits are always gonna equal. So as you have here a credit, you have a debit, now they're equal. That's the second example. Let's go through a third example real quick here. What do we got? We spent on marketing $5,000 marketing. So spend $5,000 marketing expense. All right, so you got the T accounts. You have an expense, which is marketing expense. You got cash. All right, as you spend cash, cash is going out the door, right? So it's going to be a credit of $5,000. And you have marketing expense. Expense based on this formula here for dealer, expense is right here. It's a debit. So that's going to be $5,000. You arrive at the same result if you use this method here, where you have the asset right here. Reducing it is a credit, which is what we did here. For the expense, also has a debit nature. To reduce it, to increase the expense will be a debit here to increase the expense. Let's go through one final example here. All right, we have $30,000 in revenue. $30,000 in revenue. So made 30K in revenue. All right, so when you make 30K in revenue, what are the two accounts that are involved here? So one of them is revenue, and the other one is most likely accounts receivable, right? If you're selling a credit. So you have accounts receivable, which is an asset. All right, so you got your T accounts here, one for revenue and one for accounts receivable. All right, so revenue is increasing, revenue is going up. Well, based on this, it's a credit. So you got 30K, right? And you got AR, which is an asset. To increase it, it's a debit, right? And if you do it this way, it's the same thing, right? So you got revenue. Well, revenue is always going to be a credit because it shares the same nature as equity, right? So because it increases equity, so it moves in the same direction, it's a credit. Credit to revenue. With AR, that's an asset, right? To increase it, it's going to be a debit, and always your debits are going to be equal to credits. So that's it for this lecture here. I hope you enjoyed it. If you liked it, give it a big thumbs up and share it with someone who might need it. And I'll see you in the next one.